So you want to be a stock market whiz, right? You dream of buying low and selling high, watching your money multiply faster than rabbits on a carrot farm? But hold your horses, my friend. Before you dive headfirst into the exciting world of stocks, there's something you need to know. Investing without understanding is like playing blindfolded darts, messy and potentially disastrous. Imagine buying a shiny new car without checking the engine, mileage, or even if it runs on petrol or wishes. Sounds crazy, doesn't it? That's exactly what you're doing when you buy stocks without understanding the company behind those fancy ticker symbols. This, my friend, is where the magic of fundamental analysis comes in. It's like giving you X-ray vision to see beyond the stock price and into the very heart of a company's financial health. Intrigued? Let's dive in. Think of fundamental analysis as playing detective. You are Sherlock Holmes, but instead of chasing criminals, you're on the hunt for profitable investment opportunities. Your magnifying glass, a company's financial statements. Fundamental analysis is all about examining a company's financial reports, its balance sheet, profit and loss statement, and cash flow statement, to understand its true worth. It's about separating the rock-solid businesses from the ones built on shaky ground. Why is this important, you ask? Because a company's financial health directly impacts its stock price. Strong and profitable companies are more likely to see their stock prices soar, while companies struggling to stay afloat may see their stock prices sink faster than a lead balloon. By understanding fundamental analysis, you gain the power to make informed investment decisions, not impulsive ones. You get to be the smart cookie who buys low and sells high, all because you did your homework. First up in our financial statement lineup is the balance sheet. This statement is like a snapshot of a company's financial position at a specific point in time. It tells you what the company owns, assets, what it owes to others, liabilities, and what's left over for the owners. Equity. Think of it like your own personal balance sheet. Your assets could be your house, car, savings, etc. Your liabilities could be your mortgage, car loan, or that credit card bill you've been meaning to pay. Your equity is whatever is left after you subtract your liabilities from your assets. Companies have balance sheets too. Their assets could be things like factories, inventory, and cash. Liabilities might include bank loans, salaries payable, or money owed to suppliers. Equity represents the portion of the company owned by its shareholders. Understanding the balance sheet is crucial because it gives you a glimpse into a company's financial strength and stability. A healthy balance sheet is like a strong foundation for a house, essential for long-term success. Next up, we have the profit and loss statement, also known as the income statement. This statement tells the story of a company's financial performance over a period of time, like a quarter or a year. In simple terms, the P&L statement answers the question, is the company making money or losing money? It shows you the company's revenues, money coming in from sales, expenses, money going out to run the business, and ultimately, its net profit or loss. Think of it like your own household budget. You have money coming in from your salary, and you have expenses like rent, groceries, and entertainment. Hopefully you have some money left over at the end of the month. That's your profit. Companies work similarly. They earn revenue by selling products or services, and they incur expenses to keep the lights on and the business running. The P&L statement shows you how efficiently a company is managing its operations and generating profits. Section 5. Cash is king, understanding the cash flow statement. Now let's talk about the cash flow statement. This statement tracks the movement of cash both in and out of a company during a specific period. It's all about understanding the company's cash position, how much cash it has on hand and how it's generating and using that cash. Why is cash so important? Because businesses need cash to operate, pay their bills, invest in growth opportunities, and weather unexpected storms. The cash flow statement is divided into 3 sections. Operating activities. Cash flow from the company's core business operations like cash from sales and payments to suppliers. Investing activities. Cash flow related to investments, such as buying or selling equipment and investing in other companies. Financing activities. Cash flow related to financing the business, like issuing stock, taking out loans, and paying dividends. By analyzing the cash flow statement, investors can get a clear picture of a company's liquidity, which is its ability to meet short-term obligations, and its long-term financial sustainability. Section 6 Ratio Rundown, your quick guide to financial health. Now that you have a handle on the three main financial statements, let's talk about financial ratios. These are powerful tools that investors use to analyze a company's financial health and performance. Think of ratios like a doctor checking your vital signs. They provide valuable insights into a company's well-being. Here are 4 key ratios to get you started. Price to earnings, PE ratio. This ratio tells you how much investors are willing to pay for each rupee of a company's earnings. A high PE ratio could indicate that investors are optimistic about the company's future growth prospects. Debt to equity, DE ratio. This ratio measures a company's financial leverage, showing how much debt it's using to finance its assets. A high DE ratio could indicate higher financial risk. Current ratio. This ratio measures a company's ability to pay its short-term liabilities with its short-term assets. A current ratio above 1 is generally considered healthy. Return on equity, ROE. This ratio measures how effectively a company is using its equity to generate profits. A higher ROE indicates better profitability. By analyzing these and other financial ratios, investors can compare companies within the same industry and make more informed investment decisions. Section 7. Value hunting or chasing growth. Finding your investment style. Now comes the fun part, choosing your investment style. Are you a value investor or a growth investor? Value investors are like bargain hunters at a flea market. They're looking for undervalued companies whose stock prices are trading below their intrinsic value. They believe in the power of patience and are willing to wait for the market to recognize the true worth of their investments. Growth investors, on the other hand, are more like venture capitalists. They're looking for companies with high growth potential, even if their current valuations seem stretched. They're willing to pay a premium for companies that they believe will be the next big thing. So, which style is right for you? Well, it depends on your risk tolerance, investment goals, and time horizon. Value investing is generally considered less risky than growth investing, but it may also offer slower returns. Growth investing has the potential for higher returns, but it also comes with higher volatility and risk. The key is to find an investment style that aligns with your financial personality and goals. And remember, diversification is key. Don't put all your eggs in one basket, whether you're a value investor or a growth enthusiast. Section 8. Fundamental Analysis for Beginners, Your Action Plan. Congratulations, you've made it to the end of our Fundamental Analysis crash course. Now, it's time to put your newfound knowledge into action. Here's your action plan. Start reading financial statements. Don't be intimidated. Start with companies you understand, like your favorite retailers or tech giants. Learn key financial ratios. Familiarize yourself with the ratios we discussed and explore others that pique your interest. Practice, practice, practice. The more you analyze companies, the better you'll become at identifying investment opportunities. Don't be afraid to ask for help. There are tons of resources available for new investors, including financial advisors, online courses, and investment communities. Remember, investing is a journey, not a sprint. Be patient, stay informed, and never stop learning. Now go forth and conquer the stock market, my friend.